very good afternoon to everyone. Thank you for joining us here today. My name is Chloe, and I'm a research analyst at iFAST. So today, my topic of focus will be that of the commodities sector. So to start off, just want to give some of a brief recap of the key events in 2022. So global commodity markets have surged to multi-year highs in 2022. And the world's most actively traded commodity, which is that of Brent crude, actually topped $130 per barrel in March. And this is close to an all-time record following the outbreak of the Russia-Ukraine war on 24 Feb 2022. And as seen in this chart above, many events over the past year have resulted in much volatility. However, at the back end of 2022, we started to see that the market saw a retreat as it braces for weaker economic growth. Nevertheless, despite the immense volatility experienced in 2022 as a year has been a great year for the commodities sector, especially since commodity prices have remained at elevated levels. For example, within the S&P 500 sectors, the energy sector had far outperformed other sectors by a wide margin, and is the only sector that had delivered positive returns, returning about 58% to investors. Other than the Russia-Ukraine war, I think 2022, as we all know, is a pretty significant year, as it, after all, marked an inflection point where the multi-decade loose monetary policies were being swiftly reversed following record high inflation. And you can see in the table here that the 2022 rate tightening cycle was the most aggressive since 1988. And just to put some things into perspective, rates have gone up by about 425 basis points in the span of 9 months, and it's a rate of change that by far exceeds previous tightening cycles. And despite these aggressive rate hikes, we will nevertheless be entering 2023 with persistently high inflation observed across major economies. And this unease about inflation is not new, and it's been building up for quite some time now, following the post-COVID-19 recovery as well as the persistent supply shortages due to the war in Ukraine. And not to mention, the labor market has been pretty tight, and all of this contributes to this elevated inflation being seen. And for policymakers and investors alike, these are all difficult macroeconomic conditions to navigate, and even with the aggressive rate hike, inflation remains at elevated levels and well above the Fed's 2% target. And tighter monetary policy is now starting to bite. So the leading economic indicators are pointing towards a slowdown. Your PMI indices across major markets are now in contractionary territory, and it reflects the headwinds faced by the major economy. And the health of the US economy has also deteriorated, with the US leading economic index falling for consecutive months now. And while the Fed has talked about trying to engineer a soft landing, and what this means is involves slowing an overheated economy without bringing about a recession, I think we can say that this does not inspire much confidence, as after all, the Fed has a somewhat mixed track record, and with the indicators all showing a deteriorating economy, this likelihood of a soft landing becomes increasingly unlikely. And if we take together the fact that rising prices and slowing growth are acting together, I think we'll likely see this stagflationary environment unfolding. And the stagflation has been, in terms of few extended periods of stagflation. So a last major time we saw a period of stagflation actually occurred was in the 1970s. And back then, interest rates were soaring, there was widespread food and energy inflation, and the economy was also a mess back then. But the good news, however, is that commodities, they actually tend to perform well when inflation rises, often because they are the cause of the rise in inflation. So let's take, for instance, there's actually a strong 10-year correlation between the Bloomberg Commodities Index as well as the year-over-year growth of the US CPI index. And this correlation is actually about 0.8. So regardless, stagflation or not, what we'll witness going forward is this tugging forces of a possible demand slowdown and supply tightening that will play out in full effect in the commodities market in 2023. So now markets are trying to determine the impact of a slowing economic growth on the overall demand. But while the demand risks remain, let us not forget that supply risks have not disappeared and are in fact growing when it comes to commodities. And while the short-run price movements of, let's say, your commodity prices, they are often unpredictable, especially in the short run, they are often more predictable in the long run. And with this, we'll be looking at the energy, metals, and agriculture space within the whole commodities complex. So when we look at energy, we think that prices will remain volatile, but are naturally skewed to higher prices. And it's because we see that a lot of these OPEC plus production issues continue to linger. So as a whole, OPEC has actually ignored calls from US and other key consumers to actually try to increase oil supply amidst all these higher prices and tight supply. And OPEC plus, they actually have zero motivation to try to boost production, as they squeeze the tight oil supplies would actually benefit a lot of these OPEC plus members who are oil producers themselves. And moreover, due to this whole weak economic backdrop, OPEC plus has actually announced production cuts of about 2 million barrels per day. And this would last from November till end 2023. I think more importantly, another reason why we see this is the case as the physical constraints on OPEC plus to actually increase production. And we see that there's a consistent failure of the group to hit even their own reduced production targets. So many members are producing well below their quotas and ceilings due to a lot of operational issues, as seen in this chart throughout the whole of 2020 actually. So moving on to my next point, I think we cannot leave out the fact that 2022 was a year where China had largely been locked down. And so this whole China wildcard with China reopening is something to definitely consider. So the second largest oil consumer, which is that of China, is now trying to reopen. And this whole progress on the reopening efforts could provide some upward momentum for oil prices. And this whole rapid dismantling of the COVID-19 policy, of COVID-0 policy, has naturally prompted optimism over the longer term, especially when it comes to, let's say, your commodity or energy demand. But where it stands, we nevertheless do take note that energy consumption is actually uncertain in the near term, as a lot of the virus cases surge across the country. And I think this is the most major point of all. I think more importantly, when it comes to this idea of energy prices remaining volatile but skewed to higher prices, the main reason why we think this is the case is due to the fact that there's no long-term supply response in sight. So without sufficient capex to actually increase your supply capacity, the oil and gas will remain stuck in a state of further shortages with higher and more volatile prices. So in fact, the US and the other OECD countries, they release large amount of oils from their strategic reserves, and this is equivalent to about 1 million barrels per day since March 2022. And these releases have sharply reduced the level of strategic reserves that they have left. So let's take, for instance, your US SPR is now currently at its lowest level since 1984. And it reduces the available amounts of buffers in the event of, let's say, your future oil disruptions. And despite all these falling inventories, you can see that the private sector response in the US seems to remain contained so far. So if you look at this chart here, in terms of looking at the US domestic oil production, the US oil rig count failed to rise in line with the prices, especially when you compare that they move more in line with the prices, especially over the past years. And structurally, this whole oil and gas sector is one that is defined by underinvestment, and this has been the case ever since 2014. So why the high oil and natural gas prices are not translating to increased production is due to the investor pressure to maintain your capital discipline. And moreover, I think we can all see that there's a lack of desire and investment within this space, especially given the ongoing transition in energy markets to that of lower carbon fuels or your renewable energy sources. And with this whole green transition underway, we're unlikely to see much exploration and development of new fossil fuel sources of energy. So moving on to metals, China actually looms large for this whole industrial metals complex, as again, the country is actually the world's biggest users of metals such as your steel and copper. And this whole dismantling of the country's zero COVID policy added much optimism to the metals market and may actually get a boost from the improvements in China's economy over time as they reopen. But where it stands, I think there's a lot of uncertainty with regards to the demand and whether China will recover. And in the short term at least, China's unraveling of this whole zero COVID policy actually pose a volatility risk, and demand has yet to show meaningful signs of recovery. As after all, China's construction market had actually faced a very difficult year in 2022, and is actually faced with a confidence crisis. So the home buyers are not even convinced that the developers can actually deliver the properties that have been pre-sold, given the waves of defaults we're seeing, especially over 2022. And while the recession as well as slowing growth concerns, they weigh on the current metal spot prices, the space does look very compelling from a fundamental perspective. And not to mention, following the energy shock seen following the Russia-Ukraine war, it's actually a turning point where it would actually help to boost the shift to renewable energy and clean energy sources. So the medium to long-term outlook for metals is particularly attractive as this whole green transition becomes a priority, and it brings with it a significant driver of incremental demand for, let's say, your green metals such as your copper, nickel, cobalt, lithium, and the other metals that are associated with this whole renewable energy technologies. So for instance, this electric car, it uses about 5 times more metals compared to, let's say, your conventional car. And the same also goes for other wind and solar technologies. They are far more metals as well as minerals intensive. And governments and companies around the world, they are now trying to secure all these critical metals that will play a vital role in the near future. And as usual, we see that supply side comes into a problem, as this supply side is faced with challenges, as after all, the mining projects, they do have long lead times, and they require large amounts of investment. So in terms of lead times from resource discovery to production, they can average about 17 years. And what this actually brings about is that of greenflation. So greenflation increases the price of, let's say, your metals as well as your minerals that are critical towards this whole green transition. So last but not least, we'll be looking at the agriculture commodities. So agriculture commodities, they had a good, strong 2022 with the Russia-Ukraine war, as well as the extreme weather pattern conditions that are pushing the prices higher. So while the Russian-Ukraine war has gone on for more than 10 months now, we see the fact that this whole issue of food security remains very persistent and prevalent, given that Ukraine is, after all, one of the world's biggest grain and vegetable oil exporters. And this issue of food security has been brought under the spotlight, given that the effects of rising food prices have been felt throughout the economy. And you can see all this from the governments imposing export bans, to price controls, to that of higher grocery prices that are hurting consumers. And while the food prices have actually come down a bit since the summer, I think they remain high by historical standards. And going forward, we see that climate change will continue to challenge this whole agriculture supply, as it's after all very weather dependent. So of late, there are no shortages of headwinds facing this food supply, with a lot of heat waves and droughts that are taking a toll across Europe, China, as well as India. And as the planet heats up, our weather patterns will actually continue to change, and this would mean a growing drag for your agriculture output in years to come. And despite this, you see that global agriculture demand remains strong. And in terms of the supply growth side, we're faced with a deficit. And climate change will continue to hamper this food production as they lead to severe flooding as well as droughts and challenges agricultural yields in times to come. So if we take all of this into consideration, what this naturally means is that going forward, we do expect a lot of macro as well as geopolitical and climate volatility to continue into 2023 amidst a tight supply backdrop in commodities. And what this means is that it ensures that your energy, your metals, as well as your food prices, they will likely stay elevated. And even with a recession or stagflation scenario in 2023, we think that this could be pretty mild and may not be so detrimental to the commodity sector. As after all, the reason why we think this is the case is that the commodity sector as a whole has actually strengthened its balance sheet and maintained fiscal discipline. So it's been pretty heartening to look at this whole sector and see that the energy and materials sector, which has traditionally been very capital intensive, such that 5 to 10 years ago, it would be hard to imagine that these are the two industries which will have very little debt. And in a high interest rate environment, having a strong balance sheet and little leverage would actually benefit these sectors. So overall, when we look at the whole commodity sector, we do have reasons to believe that going forward, the sector will be more resilient, and there are strong secular trends in the space that will drive its growth going forward. And while the next few months may actually be very worrying, we think that in the longer term or in the years ahead, it will be very exciting for your commodities investors. And in the longer term, we think that the demand for, let's say, your energy, your transition metals, as well as your food, coupled with the increased spotlight or your focus on, let's say, your sustainability as well as security issues, it presents an enormous number of opportunities for investors in the space. And with this, I actually come to my final slide. So within our platform, there are a lot of ways to gain exposure to the commodities sector. So for ETFs, investors can actually consider the VanEck Rare Earth Strategic Metals ETF or the VanEck Agribusiness ETF for their respective exposure above. And our research team has written articles on both these ETFs before. And for funds, there are a couple of recommendations we have. So if you're seeking a dedicated exposure to the energy sector, you can definitely consider the BlackRock World Energy Fund. And for the natural resources, the JP Morgan Global Natural Resources Fund enables one to get exposure to both the energy as well as the metals and mining sector. So last but not least on the list, we have the BlackRock Natural Resources Growth and Income Fund. And this is by far the most comprehensive fund out there, as it provides one with exposure to your energy, your metals and mining, as well as your agriculture. So in a sense, it's very representative of this whole commodities sector. And with this, I actually come to the end of my presentation. So thank you everyone and have a good afternoon.